Welcome to the Daily Update, where I'll go over the action in the market for Tuesday, July 11th, and then we'll see how things look for Wednesday, July 12th. We had an up day, not a real up day of conviction. We're still dealing with overhead resistance, both for the S&P, the NASDAQ, and the NASDAQ 100, but we saw a lot more of an improvement in our charts, but the market is now waiting for this big variable that's sitting out there, and that's going to be the CPI report that is released on Wednesday. We'll have to see how the market reacts to that, or does it end up being more of a non-event because it really doesn't tell us anything? We don't know that at this point, but that's what the market is fixated on, is inflation and interest rates. And so we get the biggest report about inflation that will affect interest rates, and that'll be the CPI report. Let's go back and talk about what happened. Right at the open, we did have a higher open with prices rising above R1 at 44.18. We then fell back and we found support at the unchanged level, which is usually that built-in support or resistance level. As the day went on, prices climbed back above R1. We got above R2 at 44.27. Then we fell back to R1. Prices climbed from R1 back above R2 to close just below 44.40. We found resistance. I look back in the chart and it's last Friday's high. We were up 0.67% on below average volume. That seems to be the norm right now. Our technicals are still positive. We have a few things that are becoming overbought now. When we chop sideways for a number of days like we have, and we get a move that's maybe over 0.5% or so, either up or down, we start getting overbought or oversold signals really quickly. And it's all about inflation and interest rates, as I mentioned. What are some comments that we can make? Support came from the broader market early. And then later on in the day, the mega caps picked up and started to do better. Value and small cap stocks continue to outperform. That's a little bit of a warning sign. We want growth to really be doing well. We want the whole market to be doing well. When you're looking at the buy low, sell high type of investments or trades, you want growth to be really doing well, and it's still lagging behind. On a short-term basis, we have our EMA study that I'll go through, the Williams percent R, and the stochastics. Not all of our usual suspects, but with the update, we're getting a few of them that are looking extreme. Intermediate term, we're keeping an eye on the oscillators because they're showing us negative divergences. We have the Sean trend meter, which was on the list, fell off the list. Now it's back on the list. And the BPI is continuing to show strength, and it's starting to get extreme positive. Now, we can look at all of this stuff in two ways. That we're getting a little topsy and we're due for a pullback, or that this is showing good momentum. Until we can get above these upper resistance levels, we're not really sure. The jury's still out on what this actually means. The dollar was down and interest rates were mixed, and the dollar declining gave some support to stocks. All of the yield curves that we follow still remain inverted. We ticked up to 79 with our sentiment where we had been at 78. That's extreme positive. Our trend is positive and the green line's starting to turn back up, so it's advancing now, but it's still below its moving average. However, both the ADX and the moving average are above 20, suggesting that we're in a trend, but it's possibly a weakening trend. Even with the update, I'm keeping our bias and momentum at mixed because of this variable with the CPI coming out. We don't know how the market's going to react to that. The economic reports that came out, we just had the NFIB Small Business Optimism Survey, which actually showed a little bit of improvement. It came in at 91. Last time it was at 89.4. Here is a chart of the optimism index showing how it's really been coming down a lot lately, showing a lot of pessimism. Well, we're seeing it bounce back up just a little bit now. Some Isabel Net blog charts. The yellow line here is liquidity, and they have this formula for figuring that out. When liquidity is going up, that is positive for the S&P. And then when it rolls over and starts to go down, that's a sell signal. Well, we're getting close to a sell signal now. Then we look at equity positioning. We're above zero and going up. That means folks are getting into stocks. Exposure to gold also has been going back up more. It's above zero. We're starting to see flows coming out just slightly. In the intermarket analysis video that I do every weekend, we have two different junk bond charts that we look at, and they're still looking strong. Then we look at the S&P 500 forward PE ratio. That's the dark blue line where it's continuing to go up. Remember, this is based on forecasts. And then the 10-year Treasury yield. And you see they're really getting far apart from each other. They tend to go in the same direction, and they tend to not get very far apart. That could cause a little bit of a concern. Are earnings going to come down, or are interest rates going to have to go down because this is an inverted scale? And then looking at the ISM Composite Index, this is economically weighted with the gray areas being recessions. We're coming down below this black line, but now we're starting to bounce back up. That could show some improvement for the economy. And a lot of folks who have concluded that we're going to go into a recession are using this chart to justify that we will head into a recession. Let's get into our charts and analysis. Here's the intraday chart where we had a higher open above R1. Didn't quite make it up to R2 yet. Came back down to the unchanged level, which acted as support. Started to inch our way higher. We got back above R1. Even broke a little bit above R2. Chopped it sideways. And then later in the day, we broke above R2 and closed right about at the high. We never made it up to R3. Here's the intraday chart where the initial overnight session was pretty much flat. Saw a little bit of initial weakness and then some strength going into the open. Then right after the cash market opened, we saw that decline, and then we clawed our way back, and we're pretty much floating sideways in the initial overnight session. And the futures are kind of quiet right now ahead of CPI. But this next chart is a little bit of a concern where we're showing value is really outperforming growth. Value was positive where growth was negative. Here's the closing basis. Now growth, even though it was negative compared to value, it was up on the day for the large caps. It also underperformed for the mid caps as well as the small caps. Here's our growth to value ratio. This is also a little bit of a concern. We're seeing on an up day where growth is underperforming value. Looking at sentiment, here's one of the Isabel Net charts that we look at. The sentiment indicator is still suggesting that we're extreme positive. The Ulcer Index also is showing that there's no fear, or you could say extreme positive. The VIX did tick down just a little bit on the line chart as well as the bar chart, and volatility was pretty much unchanged in Tuesday's session. This is positive where our longer-term equity put-call ratio simple moving average continues to decline. We saw a little bit of a decline with the equity put-call ratio. We're watching this. We're starting to break above the dashed line with our VIX to S&P 500 correlation. We want to see this top out and then start to come back down before we try to evaluate what's happening. The VIX to move ratio ticked up just a little bit, but also shows that fear is really non-existent. We turned a little bit down again with our other fear gauge that we look at, and we continue to fall with this additional fear gauge. Folks still favor a risk-on posture. That ratio continues to go up. Our advanced decline line, seeing a nice little improvement based on price and volume. We broke out above this previous high based on price where we're still lagging a little bit behind based on volume. We saw a really nice advance in the new highs, but it's going to take a little bit to turn our 5-period moving average back up. The 10-period is starting to turn back up. The equity put-call ratio is above 0 and advancing. That's positive. Accumulation distribution continues to be positive. We saw some improvement with our cumulative advanced decline line based on the NYSE. We're also seeing some improvement with our regular advanced decline line. Then the other advanced decline line for the NYSE is still above this trend line. We saw some improvement with the common stock advanced decline line based on price and volume. Looking at our advanced decline line studies, seeing improvement pretty much across the board with all the indexes. Our trend, the green line is turning back up. However, the ADX is still below its moving average, but we still default to positive because of the green line. Shorter term, we're also turning back up, but the ADX is below its moving average. Volume continues to drop off. Our short-term charts, not a lot was really decided on the daily chart. We're just kind of in a range now. We want to break out above this previous high. If we stay positive, we're keeping an eye on the August 2022 high. If we start to break lower, there's also a pivot level that might provide support if we fall. On the bottom, we have below average volume. The 20-period double and triple exponential moving average, we're still having a hard time breaking above them. But on our 20-period simple and exponential moving averages, this is still providing shorter-term support. The 20-period exponential moving average is starting to get extreme positive. We're just barely moving into that territory with the 50, but still showing improvement with the 200. The Williams percent R is now starting to get extreme positive. The short-term stochastics, extreme positive, turning back up with the intermediate term, rolling over a little bit in the long term, but still extreme positive. The force index advanced and is above 0. Looking at our intermediate charts, the balance of power continues to advance and is above the dashed line. The double and triple exponential moving averages based on 50 periods were kind of right in between the two. The double is providing support. The triple may be providing overhead resistance. We're still neutral with the go-no-go system with the lighter shade of blue bars. We're above the midpoint with the highest high and lowest low values, and we're not really hitting this upper line yet, suggesting that there's not a lot of momentum right now. The TTM squeeze continues to be positive, but it is declining. We're going back up into the second standard deviation now, not necessarily an extreme reading, but showing some improvement above the midpoint. And I've been showing this the last few days, the ease of movement, where we have the equivolume bars on top. It's green, and then based on volume, these bars are not very wide. What I'm watching is the ease of movement down below. When we're above this 0 line and going up, that's positive. We were coming down to this dashed line before we did turn up, so we're turning slightly more positive that way. The PPO studies based on the weekly chart, we're still looking positive across the board. Our Rune indicator continues to decline. We're seeing buyers dropping off a little bit, but sellers are pegged to the bottom. We're above 0 and advancing with our S&P McClellan oscillator, which is helping the summation index to go back higher based on price, and we're starting to turn back up based on volume. Our NYSE McClellan oscillator also showing some improvement, above 0 and advancing, so our NYSE summation index is advancing based on price and volume. The Swenlin trading oscillator ticked down just a little bit, but it's still above 0 based on price and volume. The PMO still looking a little bit more negative. We're turning more positive based on price, where we're still chopping based on volume. And our PMO study saw an improvement with the PMOs that are rising, a little bit of a turn up with the buy signals, and we are advancing slowly with the PMOs that are above 0. The Elder Impulse system for the S&P has now switched back to positive with a green bar. The parabolic is still positive with the dots underneath. The slope continues to decline. The MACD is also continuing to decline. So we're still seeing this negative divergence pretty much across the board with all of our different oscillators, where the S&P made a higher high, but the oscillators did not make a higher high. And I always have to explain this, that some of this is the way it's calculated. When we made this first high, we were using lower prices in the calculation. We came down a little bit and came back up. Now, when we calculate this other high that we made, it's using higher prices in its calculation, so it can't help but be lower. But a lot of folks use this to make decisions, so it ends up being a self-fulfilling prophecy. The Sean trend meter starting to get extreme positive. The BPI going above the 70 level. It still has more room to run to the upside. We just want to be aware that it's looking a little extreme. The NYSE bullish percent index is showing improvement. The Chaikin money flow continues to be positive. The Chaikin oscillator is also positive. The money flow, after dipping below 50, has now bounced back above 50. The ultimate oscillator is above 50 and advancing. The vortex, where we crossed below with the green line, well, now we're crossing back above with the green line. We're still seeing a negative divergence with the RSI, but again, some of this is how it's calculated. On balance volume is looking more positive above the moving average. We're seeing some improvement with our 200-period moving average study for the S&P, as well as our 50-period moving average. And here's that same chart showing some improvement. I just have the one line chart to show you. We were coming down to the 20-period simple moving average of the open, high, low, close. This was acting as support, and now we're bouncing up off of that. Our different charts. The Heikin Ashi is turning back more positive. We're turning up with the Kegi. That's more positive. The Renko continues to be positive, and the 3-line break is positive. Our different indexes. The equal weight had a good day, but is still underperforming the S&P overall. We saw a decrease in the overall ratio because the equal weight stocks did better than the bigger weighted S&P 500 stocks. We're still showing some improvement with the transports. We broke above this previous high and are still looking better. We turned back up with the utilities, but we're still declining overall. The transports to S&P 500 ratio continues to climb, and that's what we want to see in a good, solid environment. When we look at the correlation between the two, we are seeing a little bit of a decrease in the correlation, so that's something to be aware of. When they're both moving up, this correlation would be very high, and if the ratio is going up, that just suggests more strength in the market. The transports are coming back up and pretty much performing the same as the Dow. Looking at our equal weight discretionary staples study, where discretionary had an up day, staples ticked up just a little bit, but when you take a ratio, discretionary is really outperforming staples. The Dow has been able to go back above this pivot level, and it's above both its 50 and 200-day moving averages. The diamonds have switched back to positive for the Elders impulse system. The NASDAQ, we're still kind of in between here. We're not able to break out above this resistance, but support continues to hold. Here's the NASDAQ where we're watching the 61.8% retracement level. Internally, though, the cumulative new highs minus the new lows continue to show weakness, but if you take new highs minus the new lows, we are above zero. We're also fighting with this previous high in the NASDAQ 100. We're below resistance, but still above support. The Qs have now switched back to positive for the Elders impulse system, and we're above the 61.8% retracement level for the NASDAQ 100. The BPI is showing some improvement. If we continue to show more strength, we could get up into this extreme positive territory. The small caps broke out a little bit against this sideways conglomeration of prices, and the small caps remain positive for the Elders impulse system. We're also getting back above resistance with the Russell 2000. That's positive. The MACD is starting to turn back up, and we're turning more positive with the RSI. The small caps did outperform the S&P 500 on a daily basis, but continue to underperform on a longer term basis. Small cap growth ticked down just a little bit when compared to small cap value, but it's still in an uptrend. Looking at the mid caps, they actually broke out above recent prices, and the Elder impulse system is positive, and mid cap growth to value continues to be in an uptrend, even though it's slightly underperformed in Tuesday's session. Keeping an eye on home construction. It has just been going to the moon lately. Well, it fell back a little bit, and we saw a good solid day when compared to bonds. This is a highly sensitive interest rate area, so if this part of the market was concerned about interest rates, this ratio wouldn't be going up as strong as it is. Then the home builders also had a pretty good day. We broke out with the ETF. The ratio is also going higher, and the relationship turned back up, suggesting that the S&P and the home builders are complementing their moves. Keeping an eye on the financial sector, we're still above both the 50 and 200-day moving averages, but when we compare the financial sector to the S&P, it's starting to cross above the 50-period moving average, but is still in an overall downtrend. We saw a little bit of a tick up with the regional banking ETF, but is also still in a downtrend when compared to the financial sector. Bonds, after really going up based on yield, pulled back slightly, and price, after really declining, has bounced back up slightly. And then we look at the cash basis and compare it to the 3 to 7 year bond ETF, where the ratio's really been going up enough to see a golden cross with this ratio, where we want to see this ratio going down if you're positive on the market. And this ratio did come down slightly in Tuesday's session. We're still above the 3-month yield going back to 2007. If we start to fall below this level, is that giving us some kind of a warning sign? We're just watching this day by day right now. Our long-term analysis. This came from the Isabel Net blog charts, just showing some different areas of support or resistance that I try to keep up on with the charts that I use. The daily chart for the Special K continues to be positive. However, the weekly chart remains negative. We're seeing some improvement with our 150 and 200 period moving averages. Could be getting close to an extreme positive reading. This is what I brought up yesterday. Some different long-term charts. This is a weekly chart going back to 2009 all the way up to right now. If you do not use a log scale when you draw the charts, it looked like this chart was pretty helpful, where we went from this low to this low. Then it acted as overhead resistance a number of times, all the way up to the high in 2018, then the high in 2020, and then we continue that line going up, but it's not really telling us all that much right now. Where we see some more insight is when we switch over to a log scale. This is the 2018 high, the 2020 high, and we extend that line going forward, and we're still below that. Is this acting as overhead resistance? You have folks that are very negative on the market that are just salivating over this. Sure enough that we're going to hit this and start to go back down. We've seen other lines like this before where folks were getting all excited, just sure as anything that they were right, only we broke through this trend line and are continuing to go higher. Now, it might be different this time. We just want to be aware of this, but we don't want to use just this to make our decisions. Now, just for kicks, I went all the way back to the 1987 crash. The line that I was just showing you, where we're at right now, if you extend it back through the 2020 high, the great financial crisis where we broke below it, the dot-com bust, which ended up being a support level with this trend line, and then you go all the way back to the 1987 crash, look at how this all comes together. Very interesting. Then looking at the NASDAQ 100, where we set a low back in 2009, drawing a trend line, which acted as support in different times. We broke below that only to come back above it. Now we're starting to get back up to this area, and it may be acting as overhead resistance. So we're seeing what potentially could be significant overhead resistance in the S&P as well as the NASDAQ 100. Those are also heavily weighted by the tech stocks. They have more of an influence in the S&P, and the NASDAQ 100 is pretty much tech stocks. Now we look at a different ratio, going from the NASDAQ 100 to the Dow. The high-tech speculative stocks compared to the more boring conservative stocks that make up the Dow, we're coming back to this previous high when we look at the ratio. Could this present a problem for the market? We don't know right now. It caused a problem before, and it's taken us over 20 years to get back to this level. Now that we're coming back up here, is this signaling some kind of a top? We use other charts to make our evaluation. An update of our possible positive scenarios. The Qs underperformed the S&P a little bit, but continue to be in an uptrend. Saw a bit of an improvement with discretionary, and actually saw a little bit of weakness when we look at large cap growth versus large cap value. The large caps are dropping back a little bit down with the mid caps, and a little bit of strength with the small caps. The S&P to utilities ratio also giving support for prices to go higher. And then our broad range of the highs minus the lows, and we take a 5-period moving average, we continue to be above zero. We're also still extreme in this 10-day average of the S&P 500 highs minus the lows. The longer we stay up here, the more it suggests there's good momentum. If we really start to go down and this line goes down, that might mean that we're pulling back, and we'll keep an eye to see if it turns more negative. The 50-period exponential moving average of the new highs minus the new lows did tick up slightly because our indicator is above zero and advancing, which is bringing the red line up higher. The S&P growth to value, this is still a bit of a concern here. We're trailing off with this ratio. But when we look at the Staples to S&P 500 ratio, this continues to decline, which could give some good support to the S&P 500. So what's our outlook for Wednesday? The CPI is going to be released before the market opens. We'll be getting the PPI on Thursday. We're still positive. We're still above support. But if we really turn and start to go down, especially on a closing basis, that could turn things more negative. We will be getting CPI on Wednesday. We'll also get the weekly MBA mortgage applications index, as well as the Fed's beige book, which comes out, I think, about an hour before the market closes. CPI is what everybody is fixated on. We're keeping an eye on the geopolitical events, but right now it's inflation and interest rates that the market is really concerned with. Here's the updated calendar for how we're looking so far this week. We'll also be having another speech by a Fed governor on Thursday. The Stock Traders Almanac statistics for July 12th were neutral to positive with the Dow and S&P, where we continue to be more positive with the NASDAQ. We will be on the 7th trading day of the month, and this is when the CPI will be released. We're also keeping an eye up until the middle part of July. The NASDAQ tends to perform well up until that point. Our scenarios, not going with the down one right now because our technicals are positive, but if we really start to scream lower and then close lower, we'll be seeing if that turns things more negative. We're still defaulting to the positive side right now because that's what our charts are telling us. We're not going with the sideways or neutral trend right now because the green line's turning back up, so it's getting a little bit stronger, but it's still below its moving average overall, but both are above 20. The green line is going back to advancing. So our warning signs, those longer term signals from the charts that I showed you going back to 1987 and 2009, they are something that we need to be aware of. Other times it produced a lot of problems for the market. We'll see if it's going to play out the same way this time. Our oscillators are still diverging negatively. The VIX is showing that there's not a lot of fears, so we're using the S&P to VIX correlation chart to try to get more insight. The cumulative new highs, new lows continue to show weakness. We're still above that 2007 level with the 3-month yield. The S&P growth is still showing weakness. Earnings season is starting to happen. We're going to get a lot of the banks that will be reporting, so that's going to be interesting to see how that plays out. The one to kind of keep an eye on, I would think, would be JP Morgan because they're the biggest. If they do well, then the other bank stocks may tend to do well also. Our positive signs, we still have positive seasonality and setups that I went over in the weekly video that are remaining in the background. The daily chart for the special K is positive. The weekly chart is negative. Our long-term equity put-call ratio remains positive. We're still above that downtrend channel upper line. We're still in a risk-on posture. The transports are starting to improve and actually breaking out. Lower price levels have so far held up as support. The S&P is outperforming utilities. The NASDAQ, which is dealing with that 61.8% retracement level, and the NASDAQ 100, which is dealing with that previous high, they're still looking positive, but this is pretty significant overhead resistance. We also might have that longer-term trend line that we're looking at for the NASDAQ 100. The Staples to S&P 500 ratio is declining, which gives good support to the S&P. The Russell 2000 index is showing some improvement, and we saw a recent golden cross. We also saw that with the mid caps, but be warned, with the S&P small cap index that we also look at, we're not generating a golden cross with that. Small and mid cap growth continues to be positive, especially mid cap growth. The Vortex indicator, which I had on the negative list yesterday, has now come back onto the positive list today. Our conclusion, the S&P, it remains positive, but if we see a lot of selling and start breaking support, that's going to switch things back more negative. If we start to go higher and actually close above resistance, that's going to turn things even more positive. In the short term, we're staying positive for right now. We're kind of overbought, but not fully blown overbought. Intermediate term, we need to see more follow-through buying to turn these things back more positive, but we still remain positive in the longer term. Thank you. Have a really nice day, and I will talk to you in the next video.